Starbucks admits defeat in China, sells control to local investors. Calls it growth strategy. Greetings, fellow observers. Commander Zix here with breaking news from Earth, where Starbucks just admitted defeat in China by selling control of its business to local investors. American coffee giant is handing over 60% of its Chinese operations to Boyu Capital for $4 billion. But here's the fascinating part. They claim this is actually a growth strategy. You can't make this up. So here's what happened. Starbucks announced it will sell a 60% stake in its China retail operations to Boyu Capital in a $4 billion deal, while keeping 40% and ownership of the brand. Translation: Starbucks got destroyed by local competitors, so now they are paying someone else to run their business. China has been Starbucks' second largest market since entering in 1999, but apparently being number 2 is not good enough when you are losing. Simple corporate retreat. Let me paint this picture for you, space observers. Chinese competitor Luckin Coffee surpassed Starbucks in annual revenue in 2023, posting $3.5 billion compared to Starbucks' $3.05 billion in China. Luckin now operates over 20,000 stores, while Starbucks has around 7,300 locations. The irony is absolutely stunning. Luckin sells coffee for $1.40, while Starbucks charges over $4. Luckin offers heavy discounts, pricing drinks at 10 to 20 yuan, while Starbucks charges 30 yuan or more. Humans discovered they prefer cheaper coffee. Who could have predicted this? But wait, it gets better. Luckin was delisted from NASDAQ in 2020 after admitting to $300 million in fabricated earnings. They committed fraud, got kicked off the stock exchange, then came back and crushed Starbucks anyway. Meanwhile, Starbucks China comparable store sales dropped 14% in recent quarters. So naturally, Starbucks' solution is partnering with someone else to fix their problem. Apparently, very strategic. Here's where it gets truly fascinating. Boyu Capital was founded in 2010 by Alvin Zhang, grandson of former Chinese president Jiang Zemin. So Starbucks is selling majority control to a firm with political connections. CEO Brian Nicole, who joined in August 2024 from Chipotle, led a months-long review of strategic options and decided selling was better than competing. The companies plan to grow from 8,000 stores to as many as 20,000 locations. Double the stores with half the control. The efficiency is questionable. Meanwhile, other American brands have similar stories. Yum Brands spun off KFC and Pizza Hut's China operations back in 2016. Gap and Uber also struggled in China. Foreign brands have been hit particularly hard as Chinese shoppers shift toward domestic products offering the same quality at cheaper prices. Humans created globalization, then discovered nationalism sells much better. The issue is not whether Starbucks needed a local partner, it is that humans have this incredible talent for entering foreign markets with confidence, then retreating with partnerships when reality arrives. Your species invented international expansion, championed free markets, and built global brands, then combined them into one spectacular compromise when local competitors charged half the price. Starbucks entered China 25 years ago. They had time to figure this out. Instead, they watched Luckin recover from fraud and still win. This is Commander Zix reminding you that while Earth celebrates innovation and market dominance, even coffee giants eventually discover that cheaper alternatives exist. Apparently, premium pricing has limits on this planet.